particular chart. This is the Nifty chart, and I'll explain to you why I have pulled the time period January 2002 to January 2008. But what I'd like you to note about this chart is that during this time period, Nifty moved up from 1100 points to 6300 points in a space of 6 years. From Jan 2002 to January 2008, the markets were up by nearly 6 times in a space of 6 years, which is a compounded return of 33% per annum, right? And this was along with a lot of volatility that came. There were 7 double-digit corrections, as you can see on your screens. 2 of those corrections were of the order of 30%. Now, I'm talking about some history to you. Is there any relevance to today? And that's what I'm going to explain to you. So look at this profit growth chart. This is the corporate profit of India to GDP. Corporate profit to GDP means summation or total of all the companies' corporate profits divided by the nominal GDP of the country. And I showed you this chart, which started in January 2002 and ended in January 2008. And it coincides with this time period when India's corporate profit to GDP went up from 2.2% corporate profit to GDP to almost 8% corporate profit to GDP. This was kind of a golden era, not just for the stock markets, but also for the economy and for the corporate sector. And after that, post the global financial crisis, we had the Asian crisis here, we had the COVID pandemic here. So basically, if you see this entire time period, we have been marked by a lot of headwinds, and this corporate profit, which had gone up as high as 8% of the GDP, came all the way down to 1.9% of the GDP, right? And we believe that this golden phase of the economy, of the corporate sector and the stock markets, is set to repeat itself once again over the 6 years, starting January 2020 to January 2026. We believe that these 6 years, you can see corporate profit to GDP scaling up to anywhere between 6 to 8%, effectively creating the same magic, in fact, effectively creating the same amount of wealth, offering the same multiplication of your wealth that you saw during 2002 to 2008 period. So during this time period, Nifty obviously moved up by 33% per annum, as I showed you. Corporate profit to GDP went up from 2% to 8%. And we expect, so this is the Nifty EPS chart. The Nifty EPS was 471 pre-COVID pandemic, but through the COVID pandemic, it went on going up to 542 and 730. And we expect in the next 3 years, this 700 rupee Nifty EPS could double once again to 1400 plus, implying a very strong growth in profits, similar to what you saw in this cycle, right? And so if people are worried about the fact that Nifty has gone up from 12,000 to 18,000, in context, the Nifty profits, which were 3.6 lakh crores in March 20, are set to double to 7 lakh crores. So really, if stocks are slaves of earnings, then if corporate profits go up, it should not surprise you that the stock markets also go up. And if corporate profits double from 3.6 to 7 lakh crores, there is no reason to believe why Nifty cannot double from 12,000 points to 24,000 points. And now you will be able to understand this chart better. I believe that January 2002 is similar to the January 2020 point that you saw when Nifty was at 12,000. 2 years later, Nifty was at about 50% higher. 2 years later now, from January 2020 to 22, Nifty is about 50% higher. And I believe that you are in the first 25% of this bull market with a lot of returns still ahead. And that is why it is very important to buy right, sit tight. That is why it is very important to stick to quality. And NTDOP offers a fantastic QGLP portfolio of stocks which have generated very strong outperformance over the benchmark of 5% per annum compounded for the last 14 years. This 2002 to 2008 cycle that I talked to you about had many sub-cycles within that playing out. So one was the housing cycle. We believe that the housing cycle, which was full blown from 2002 to 2008, right, is set to repeat itself with RERA in place, with affordability index at the best ever. So the number of months of income that it takes to buy a house used to be as high as 58 months. That is down to 27 to 28 months. And we believe that this is very attractive. In fact, the most attractive that it has been in the last 20 years. And that should drive demand for housing. And housing is the biggest sector in the economy. And that should in turn catalyze the overall economy and the GDP growth as well. Gross fixed capital formation, which also saw a very strong build-up during 2002 to 2008, and then saw a correction over the last decade, we think should pick up from here on the back of three components. One is corporate, second is government, and the third is household. We believe that the government has been laying a lot of emphasis in terms of raising its infrastructure spends and budgets by 25 to 30% in the past. We believe that households capex, which is reflected in real estate, should come back very strongly. I showed you the affordability index chart earlier. And then the corporate capex, in our view, should come back as demand and capacity utilization for the corporate sector improves. All of that should lead to improvement in credit growth. Credit growth used to be languishing at about 11% in that previous cycle, went up all the way to 30% plus, and averaged at 23.5% in the following 5-7 years. We believe that corporate credit, industrial credit growth, which is at just 2% now, should once again rise to double digits in the next 2 years' time and eventually scale up to high teens during this cycle. Once again, there are several drivers, as I mentioned, to kickstart the capex cycle. We already have cement sector, pharma sector, IT sector, which are reporting good set of numbers. We have strong government fiscal response in terms of the national infrastructure pipeline, which is giving you a strong visibility of growth. We have government reforms like GST, bankruptcy, lower direct taxes, production-linked incentive scheme, which is a landmark scheme. And we've seen a huge repair in the corporate balance sheets. So we think that with the credit crisis repair and a consonant global cycle, we think there are all the ingredients of a strong capex cycle. So net, just to conclude, we believe that the 2002 to 2008 cycle of economy, corporate profits, and stock markets is set to repeat between January 20 and January 26, where Nifty can go up by 5 to 6 times. We have just seen Nifty go up by 1.5 times, and this will be well supported by strong growth in profits. And that is why it is important to buy right, sit tight, hold a quality portfolio through the cycle so that your wealth can see the magic of compounding. This period will not be devoid of any drawdowns. We've seen drawdowns happen every year in the last 21 years. In fact, throughout the history of the stock markets. And it is very important through these drawdowns to hold on to your equity portfolio so that you can fully benefit from the expansion in corporate profit to GDP, from the beat and upgrade cycle in corporate profits, from the strong growth in corporate profits that we see. Turning to the next $1 trillion opportunity, this is a product which gave you a compounded return of 24% per annum and a double-digit alpha for a 9-year long period without any interruption. Then on the back of the COVID crisis and the slowdown in the economy, we saw a small correction in the NAV from 58 to 49 rupees. And this has now bounced back to 90 rupees. So effectively, a crore rupee invested by anyone in the fund has now become 9 crores. The same crore rupee invested in index would have been 4.8 crores. So you have been able to increase your wealth by 4 times more compared to what the benchmark would have done. And the fund, through the life of the fund, has generated 5% alpha per annum. But this 5% alpha has only been captured by those investors who have stayed invested in the fund for the long term. Again, on a 3-year rolling basis, the fund has consistently generated. The blue part of the bar that you see is the alpha. The yellow part of the bar that you see is the index return. So through the life of the fund has generated very strong alpha. barring the last 3-year time period when the COVID impact on the portfolio led to a small correction. But even during this period, there was no underperformance. So there's no 3-year time period, barring the last 3-year time period, that we saw a small underperformance in the portfolio. We have been presenting NTDOP to you every quarter, and this is a comparison of how NTDOP portfolio is behaving versus the other 4 top PMSs. And across the top 5 PMSs, if you see quarter on quarter, NTDOP's performance has been improving, and it is now among the best performing PMSs in India. Again, if you look at the 5-year rolling returns of NTDOP, NTDOP has generated over the 14-year life a 5-year rolling return of 21.5%. The benchmark has generated 11.5% return. So effectively, you have managed to earn 10% excess return on a 5-year rolling basis. In terms of the portfolio characteristics, we have run this product as a multi-cap product where we've invested roughly half in large caps and half in small and mid caps. But more importantly, we haven't bought these large caps, but we've bought small and mid caps, which have become large caps. As you know, we had bought a company called GlaxoSmithKline Consumer, which eventually went on to become Hindustan Unilever. We had bought a company called ING Vysya Bank, which went on to eventually become Kotak Bank. We had bought Eicher Motors, Page, Bajaj Finance, Voltas as small and mid caps. They've all gone on to become large caps. So that is really the concept of the portfolio, is to buy winners very early, patiently nurture those holdings through the ups and downs that the business sees, so that over long periods of time, we can benefit from the value migration in favor of these companies, the wealth creation in these companies. In terms of our QGLP philosophy, the quality of the portfolio is fantastic. It has a 20% return on equity. The growth rate of the portfolio is very good at 24% earnings growth per annum. Longevity of all the companies is quite high, and the valuations of the company at 17 times forward P and 1.2 times PEG is very attractive compared to the benchmark. Now let me compare how NTDOP stacks versus the benchmark. So the return on equity, which is a good representative of quality of the portfolio, stands at 20%. It stands at 13% for the benchmark. So NTDOP is far superior in terms of the quality of the portfolio. In terms of the growth of the portfolio, NTDOP's return on earnings growth is expected to be 24% per annum. And that is without owning the commodity stocks. Despite including commodity stocks where predictability of earnings is low, the earnings growth of index is likely to be lower at 23%. So here again, NTDOP is superior. And if you look at the valuations, which is PE divided by the growth, historical PE divided by next year's EPS growth, NTDOP's valuations are 1.2 times, much cheaper than the valuations of NSE 500 or the benchmark, which is at 1.6 times. So basically, if you are looking for how the fund can perform in the future, we believe that stocks are slaves of earnings. So if the earnings growth of the portfolio is likely to be 24% per annum, there is no reason to believe that the fund cannot deliver similar returns, particularly because the return on equity is superior and also because the valuations are lower than the benchmark. If a superior ROE and a superior earnings growth portfolio starts trading at the same valuations as the benchmark, 1.2 going to 1.6 implies a 35% return on the portfolio. And even if 1.2 stays at 1.2, but the earnings growth of 24% converts into stock returns, that could imply a 24% portfolio return per annum. So basically, the portfolio is very well positioned in absolute terms, very well positioned relative to the benchmark. And these are among the most attractive metrics compared to peers, as well as compared to the history of NTDOP.